Hern has helped us with where we're going to put Chase. He's also going to help us how first home buyers can actually get out there and buy their first home. There's 3 strategies. I don't know what they are, but Matt Hern, you're going to tell us all about it. Is that correct?
I absolutely am, because this is such a hot topic at the moment. Like even yesterday, hi to everyone at Gloria Jean's Vic Park, because they again nailed me for this topic. How can we as young people afford our first house? Is it totally out of our reach? So it's a really hot topic, and probably is on your mind as well.
Well, yes.
There are three major things. 2 are perhaps obvious and that you have thought of, and I'll mention them a bit later in the interview, because even though they're obvious, they are the ones that when I suggest them have very big resistance in them, so I think it's worth touching on them. The third one is perhaps an element that people haven't thought of, and that is save as fast as the property prices are going to grow. So many people try to save a deposit very slowly and somehow think that by the time they've saved a deposit, they're going to miraculously be able to afford it. But the property prices has grown, the deposit needs to be larger.
What percentage profit should be, percentage deposit, I should say, should people be aiming for these days? Well,
you always used to say 20%, but that becomes out of reach these days. So the banks will tend to lend around 95% of the property. So if you can get 5%, then you can get your foot in the market. And that's really what we're talking about today, is how do you get in? So let's aim for 5%.
Mathematically speaking, then, if you're, say, that value of the house that you're looking at's gone up by $50,000 over the course of the 12 months, and you're trying to save 5%, it means you need an extra $2,500 more savings than what you otherwise would have had.
Absolutely. And the other thing is that if you're looking to it for a $200,000 or $300,000 property, that deposit at 5% is $10,000 to $15,000. So that's not that much. It's it's certainly achievable, but many people sort of save a bit slower than that. So the save as fast strategy, for me, is I also find that the one we're going to talk about is managing your expectations. And $200,000 property, most people balk at that. When I mentioned that you need to lower your expectations. But the way to catch up is that every amount of money that you can save is just like you buy a property by using money borrowed from the bank. Invest using money borrowed from the bank. So gear your investment. So put $1,000 a month in maybe to your investment. Get the bank to lend you another $1,000, invest that total of $2,000 per month in, say, a managed fund, because it's easy at that small amount of money, and then you gear for, say, 5 to 7 years, and you would have played catch-up with the property market. So hopefully that's the strategy.
All that borrowed money with interest rates going up and stuff, is it still achievable?
I think it is, and I think really if you don't do something like that, the property price is going to be going up faster than you're saving, in which case you're basically saving yourself out of the market rather than saving yourself into the market, because you're
I was just going to say, for students, you said $1,000 a month. Now, for a lot of students out there, young people, it is it's hard to save that amount, especially if you're full-time study.
I'm not thinking here a student is affording their first home house, and this is where perhaps we jump into manage your expectations. Is that
make a choice?
But there is a lot of students I know out there that, all, people that have travelled maybe for 2 years after school, so they are that little bit more mature. But they, they're older students that oh gosh,
and
I'm 24.
That's talking about people who are working, Anita.
Yes, but even so, like
if you're backpacking, it means you don't get a house.
Yeah, but there's still students there that want to get that degree so they can get their dream job, their dream career, so they are making that, the 3-figured,
Absolutely,
number.
And they are, and that's where manage your expectation comes in, because I think really the best way to think about this is think of it as a 5 to 7 year proposition. If you're thinking sometime in the next 7 years you'd like to buy a house, you need to start planning to achieve that now. So if you're a student at university now thinking by the time I'm 25 I want to have my first house, start thinking the moment you get your first graduate job at, say, $35,000, $40,000 a year, that you can't buy it that year potentially unless you're willing to buy a very cheap house. So that's really it. There probably is no answer that for a student first year out of uni to buy a house without going to a very, very cheap property.
Or have very, very, very nice parents. Now, so that's point one is save as fast as the property grows, all right? You're not the normal scenario. Okay. You're not the normal. Let's talk about the normal people. Save as fast as property prices grow. Please bear with us. The second thing is lower or manage your expectations. It seems to me now that every 19, 20-year-old comes out of school thinking their first house needs to be 4 bedrooms, 2 bathrooms. Now, when I was a kid growing up, a first home was a 3-bedroom, 1 bathroom was a nice one. Have expectations changed?
Well, yes, they've certainly increased, because And that's just the natural part of humanity's existence and evolution, really, that they increase. But really what it is because we've grown up in an environment where we've lived in a very nice house because of our parents' hard work, we don't really want to downgrade, and that's just human nature. You don't want to downgrade your comfort levels. But the reality is that's what our parents did, and we probably need to do the same. So if you're a single person wanting for your first house, then maybe look for a single person's house. Maybe a 3-bedroom, 1 bathroom out of your reach as a single person, because a 4x2 or 3x1 is affordable because it's a couple's house if a couple buys it. If you put 2 incomes together and say have a net combined income around $80,000 to $100,000 gross, that's affordable to buy a $400,000 house. So when you're single wanting to buy your first house, think of a single house, and then when you eventually, when life evolves to you having a partner to join with, then you buy your partner's house. So that's part of the managing your expectations.
There's another aspect to the expectations equation though, isn't there? Because basically how you live while you go through the process is on balance as well, isn't it?
Absolutely. I often find it interesting that people suddenly think that the moment they get a mortgage, all of a sudden they're going to be able to afford $20,000 a year repayments, yet at the moment they can struggle to put $500 per month, which is like a quarter of that. So really the save as fast as the property market grows, another element of that is work out whatever size house you want to buy, what mortgage that'll cost you and the associated repayments. Save that right now. And I know I've mentioned that before, but that's really it. So if you work out the repayments and start saving that every month and then double that up by using the gearing, then within 5 to 7 year horizon, you will be able to afford that first house.
Okay.
But be prepared to take a few losses in the meantime. I mean, you might be used to having steak every night of the week and big fancy, you know, go out to dinner and go to movies and things. That's fine. Make a choice, isn't it? Basically, it's like you can keep that lifestyle. It's going to take you longer to get into your house.
Yeah, absolutely. And if you don't want to do that, then the other flip side is you go into the third criteria, which is boost your income.
Yes,
the fastest way to get in there is to boost your income. And again, I often find that this is, well, that's obvious, right? If you've got higher income, you can get more borrowing capacity. But usually people resist it because they're not really sure how. The basic rule of thumb is you'll get paid more when you're of more value to society / an employer. So for a student, really investing in their education and becoming very good at it and working within your passion is usually a great way to boost your income, because when you're passionate about what you do, you're usually just very, very good at it, and other people gravitate towards you, do a great job, and therefore you provide more value, and therefore you can ask for more value in return in the form of a higher salary. So things like that.
What about shares and stuff, like putting a part of that towards shares, or is that too much of a
strategy?
Is that okay? So is that too much of a risk?
You wouldn't consider this gearing strategy unless you went to the aggressive type managed funds and asset classes, which is share market, for example, and property market. So absolutely, but it's not too much of a risk because a property is just as risky as the share market.
That's true.
Okay, I know I'm just a heretic to all those property lovers out there, but in reality it absolutely is.
Oh, I think a few of them are really recognising the volatility of their investments at this point.
Yeah, absolutely. So the share market is not too risky. Put your savings in there, but if you're going to do that, you need a 5 to 7 year time horizon. So that's why I say this is a 5 to 7 year time horizon. Buy your first house in your late 20s. Not necessarily straight out, if you're not willing to compromise on the type of house it is.
I noticed
all swings and roundabouts.
You've got those 3 areas there, so save as fast as everything grows, focus on boosting your income and obviously trading and whatever goes with that, and maximising. Again, this is where the super comes in, isn't it? Because you're maximising what you're already spending.
That won't help you buy a house though, super. No. Although there's the first home savers accounts.
But we'll go into that another day possibly. Lower or manage your expectations, either of your lifestyle in the meantime, or the property you want to buy if you want to make it a shorter period. Makes sense?
Exactly, it does make a lot of sense, and thank you once again, Matt.